Welcome to my channel. I'm the cover call guy. Today we'll be talking about the stagflation signal. Before we get started, legal disclaimer: this content is for informational and educational purposes only, and is not financial advice. I am not a licensed financial advisor or tax professional. All opinions are my own and may be incorrect. Trading and investing involve risk, including loss of principal. Please always do your own research and consult a licensed professional before making any financial decisions. I'm just some random idiot you found online, and I could be completely wrong. All right, with that out the way, I really want to talk about this because Home Depot just put out their earnings on November 18th, and I was digging into it for about a whole day and trying to put this video together. And because October's job report is not being released, and that's really hurting the market right now. There's a whole bunch of things going on in the world, and it's just a lot of things is happening right now, and one of the things that are happening is that the mass layoffs from these companies. And looking at Home Depot's earnings, right? Yeah, it is leading to it's telling us it's telling us a picture, but we can kind of build the whole story around it, right? The earnings is telling us there's a housing freeze, right? There's mass layoffs, and that it leads to my point in this video, where this is why we need a second income, because of things like this. Like, the economy is not going to always be good forever. The economy is not going to be good for a year, 2 years straight, and then the third year, like, it has to tip off somewhere. It has to cool off. And I really hope this starts to wake people up, because the importance of having a secondary income and building it to like an actual salary is absolutely game changing. It's changes your life even at like 1/4 of your salary. So let's talk about Home Depot's quarter 3 2025 earnings, and then we'll talk about the necessity of the importance of having that second income. Start building it as soon as possible. This is the stagflation signal. I think we're heading into it's gonna get worse before it gets better. So we should embrace the suck. So don't be scared of the dips. All right. So key findings at my first glance, right? They came out and said the metric was about 2.8 growth, but they're not really sure by it. But when we dig into it, it was driven by a $900 million acquisition, right? So the organic growth was only 0.5, so it's not so great. Um, core core business was actually shrinking in real terms. Um, it was actually getting smaller. The operation or margin was 12.9%, but the interpretation that I found was that it was negative, right? It was mostly leverage. Expense was rising faster than sales, and they were doing and that led to implication of cost cutting cycles, layoffs likely to accelerate. So I think they're gonna start laying off more people, which in turn, of course, nobody has money to spend, nobody has money to buy these things. And then the housing market is just a 30-year low right now. Market is kind of frozen. There's no renovation catalyst, right? Not a lot of people buying. It's very empty. Their sales are just dipping. Uh, and then income from REITs, appreciation from physical REITs, or just not doing so well right now, right? And that leads to the labor market with the October layoffs. The October layoff is expected to be like all-time high, breaking all previous records. That's why I think the White House is not releasing. So a lot of this leads to build a second salary immediately to hedge against a job loss. Protect yourself. Always pay yourself first. Always think about yourself first. All right, so this is just my kind of my summary before we start. Right, the middle class squeeze. Home Depot's earning act is a high fidelity barometer for the U.S. economy, because you can start predicting how good the economy is based on how much home building and home sales and all this renovation, right? Because a lot of that is money. That means people are buying houses, building new houses. So a lot of this matters, and so the data reflects the consumer confidence. And right now, we're witnessing a widespread deferral of large-scale discretionary projects as households face persistent inflation and high borrowing costs. Of course, I'm talking about right now America, and if America or China, sneezes, the whole world catches a cold, especially America, right? America's number one global economy in the world, and if America starts to slow down, the entire world starts to slow down. And now we're seeing expansion to preservation. The economic cycle is shifting from asset accumulation, wealth built by rising home prices, to preservation, survival depending on liquidity. And then when there's no job, it's not liquid, right? The market is very, very stale. With housing turnover at historic lows, and labor markets cracking, the traditional reliance on single salary is becoming statistically precarious, right? This channel is all about financial freedom via, income investing, cover call ETFs, or however you do it. If you're cover call and dividend investing, welcome. I used to be a dividend investor myself and a growth investor. I have no issues with that. It's just my timeline to retiring. I didn't want to go past. I really did not want to go past 55. That was like my last resort, my worst case scenario. But I was like, you know what? If I can retire by 40, which I'm on the path to, I could maybe retire earlier than that. But 40 would be my top, right? I would just keep building and buying the dip, which we have the great opportunity right now too. All right, so reading Home Depot's breakdown, my take is that it's the illusion of growth right now. It's all fugazi, it's all fake. I don't think it's really growing. On the surface, I see that sales grew 2.8% to 41.4 billion. However, breaking it down on a forensic level, I think this is just financial engineering, right? Inorganic boost was 900, came from GMS Inc. acquisition, right? Without GMS, the growth was a meager 0.5%, 200 million. Hence why you see the massive slowdown and the layoffs, because I don't think Q4 is gonna be good in next year. All of 2026, maybe. We don't know. It just depends on what the Fed tries to do with the rates, because they have to tame inflation. If you keep cutting the rates, the inflation is just gonna go higher. Yes, money is easier to borrow, but everything costs more. So it's kind of like, what is the point? All right, so real term negative, adjusted for inflation, the core retail engine is shrinking. The 2.8% headline makes a stagnation in underlying consumer base. All right, you can grow 2.8%, but if everything else outpaces 2.8%, it's nothing. All right, volume decline in pricing limits. These next few slides is going to be about Home Depot, because it relates to, the secondary income, right? So 0.1% for U.S. comparable sales, negative 1.4% for customer transaction, and about $90.389 for the average ticket, right? So the average it just means that's up 1.8%. Revenue is being sustained by price hikes, a strategy which diminishing returns. So everything it looks good that the number is going up, but it's going up because of inflation, not because people can pay more and are buying more. So a lot of that distortion where, we're up 200 million compared to last year. Yeah, but because prices are up and people have to spend more, not because they want to spend more, right? So a lot of that is very, very misleading. Right, profitability, the hidden collapse, right? Gross profit analysis, while gross margin remains at a flat 33.4%, absolute dollar analysis is revealing $300 million increase in gross profit dollar was overshadowed by the $900 million in sales injection from GMS. This implies organic gross profit was negligible, masking a volume-driven profit stagnation in a legacy business, right? Which leads to negative operational leverage. Operating margin fell 12.9%. The leverage ratio is negative 1.43. And that means for every 1% of sales growth, operating income declines by 1.4%. Cost, labor, integration, or rising faster than sales is a rare red flag for sustainability, right? Think of it as NAV erosion, right? Basically, you're paying out more than you can bring in, and you have to eat into the NAV to pay it out. That's basically it. It's a slow, steady decline, right? So volume decline and pricing limits. Oh wait, I go back. Yeah, I went back. The weather excuse. Patterns of excuses, right? Management site lacks of storms as a headwind. But I think that this is actually a significant portion. If a business model requires hurricanes to meet earning targets, it's indicate a fragile event-dependent operation rather than a stable staple, right? So um, they can blame it on cynical, but if it's more than a cynical cycle, we have to look at the bigger problem, which I think is inflation, right? The cost of things are going up higher than people are willing to buy. Therefore, sales go down. Therefore, layoffs. Therefore, nobody's buying anything. Therefore, sales go down again. So it's a whole cycle. And then, of course, their outlook was grim. CEO had to do a downward revision, meaning, hey, we're just expected, less growth, and a lot of it is just going to be from the acquisition. So it's not organic recovery. Which leads to, of course, another part of the economy, which is the housing freeze, right? Home Depot is intrinsically linked to a housing turnover. A 30-year low turnover rate has plummeted to 2.8%. Only 28 out of 1,000 homes sold in 2025, right? The lock-in effect, because homeowners with 3% mortgage from the COVID refused to trade up a 6.5% rate, creating a great stay, right? They're locked in forever in those 1 or 2%. And then the wealth effect erosion, 53% of homes shed value last year without rising equity. The move-in renovation spending that drives Home Depot revenue has evaporated, right? So home prices has tanked in some majority of southern states, right? Has went below the market value. All right, the labor tipping point, hiring collapse. Like I've mentioned, my retailers plan to hire 265 to 365,000 seasonal workers, down 40% from 2024, right? This is the lowest since the Great Recession of 2008. So this is the lowest since the Great Recession. We can expect that what we are expecting now is going to be worse than the Great Recession of 2008. For those who were old enough to experience it in America, right? It was not a good time. Layoff acceleration, like I said again in previous slides, October has cut at least 153,000, the highest October total since 2003 that we know of, because data has not been released. So we are expected to have that higher number. The White House is not releasing October, and that is what's really shaking up the market. So things to look out for, right? It could be much worse. That's what we're expecting from what we could gather from public information. Consumer deferral rate, CFO explicitly warned of homeowners deferring projects. Uncertainty is causing a massive pullback in discretionary spending. And then here comes the importance of this video, right? The second salary imperative, right? I always try to convince others, if you don't have the time to work a second job, or you don't have the opportunity to work that overtime, you need a second salary. And what's the best way to get a second salary? Passive income. I mean, why work for the money, right? Make your money work for you. That way you can sleep at night and get your beauty sleep. So in an environment of negative operating leverage and accelerating layoffs, relying on an employment salary is an unhedged risk. Income investing provides immediate liquidity and layoff protection. Why would you not want a second salary? That's the big question. If you're new to the channel, welcome. This channel is all about freeing yourself, right, from the rat race, from escaping, and the second salary is going to do that for you. I hope you guys have watched the other videos and you're watching this video up to this point, because I mean, life I think it's only going to get worse. I don't really see prices going down. It's been about a year into the Trump administration, and I don't know. I think it's going to get much worse before it gets a whole lot better. We got to brace for it, because if NVIDIA earnings doesn't make it, oh man, the whole market is going to tank. So the whole U.S. economy is banking on NVIDIA's earning reports today. So let's pray for that. All right, the instrument class A, the cover call ETFs, right? We have these are just examples. I'm just putting this example. I like to put, sometimes I'll put the same, sometimes I'll put different. It's random. I pick and choose. I mean, I'm not favoring one over another. I try to use different cover call ETFs that are, at least in my books, good. I would never try to put an ETF out there and use an example if I don't think it was good or decent. So we have XYLD. All of these pay monthly, right? So you can take a look at it. XYLD is SP 500. JEPQ is NASDAQ. and JEPI is also SP 500, and it's just I'll put it there because JEPI is more, it's seen as a more traditional defensive cover call ETF, so it's much more low volatile. So just a few examples for you guys to see. Obviously XYLD has the highest yield, but you know it might not have the best NAV growth. So check it out, see it if you don't have it. I think these are 3 good ones for upcoming uncertainty. JEPQ and JEPI has been proven to be very, very rock solid. And in the bear market reality check, guys, the market goes down, right? The market is going to go down. By how much? We don't know. But the market is going to go down. It cannot go up forever. There has to be downside, right? There has to be some corrections and you're going to have downside exposure to the market. That's just how a market works, right? So, you know, cover calls, they do have some downside protection. You can go for the hedged, right? You can limit your cover calls. You can go into different assets, but prepare for it. You know, you should always have some type of hedge in your portfolio. That's what I believe. I mean, don't go full on aggressive attack, but you also have to play defense. And then instruments, Class B, real assets and growth, right? There's the monthly REITs and there's dividend growth, SCHD. This video, I'm not going to go all in cover call ETFs. It's more of, you know, everybody's welcome to put in their opinion. It's all of it is paying you money. At the end of the day, you are creating a way out to escape. So these are just different types of assets for you to buy, right? And I put this REITs. I mean, I was gonna put realty income. I think realty income is by far one of the best monthly single ETF. I mean, single stock. But yeah, I just put this because I know everybody knows realty income, but you know, EPR is kind of like the underrated underdog, or not really well known. And of course, SCHD. I'm sure everybody knows that, heard of that, right? Huge community in Reddit and X. Yeah, it's very defensive. So you know, you have your pick to choose from. Right, the second salary portfolio matrix, and these are just the tickers that I've listed. It just depends on what you want. Different yields, right? Different tax treatment, and of course the different markets. So yeah, these are just examples. There's a whole bunch to pick from. All right, my verdict right here: Home Depot earnings are a systematic warning. The economy is transitioning from expansion to preservation. Passive reliance on employment is a strategic error. Build your second salary now to construct a financial firewall against the stagnation signal, right? You have to outpace the growth of everything for you to actually be able to survive. Nobody wants to live paycheck to paycheck. Who does? That's depressing. That's very mentally draining. You know, that's very exhausting. I know a lot of people don't make a lot of money. And if you do, you know, leave a comment. Let us know what you do for a living. Perhaps you can inspire someone that's young to go into that field. But yeah, guys, especially those that are, you know, 17, 18, 19, 20, you know, start looking into building a secondary income. You know, start planning your escape. I know that the younger you are, the earlier you start. I mean, I really wished I started investing heavily when I was 18, when I first was introduced to it, maybe 17, 18. But man, if I were to actually get into it when I was that young, when someone was showing me the ropes, I would have been retired by now. I would have been retired before 30. And that's true, you know. On a minimum wage job. If you're working a minimum wage job, try to do better than minimum wage. If not, then you do a crazy amount of overtime. You know, that way the overtime feeds into investing. But man, nobody can sustain an 80, 90-hour work week for years or decades, right? So start planning your escape, because I think the economy is just going to get worse until we actually see something in the economy break for it to reset. All right. Please, you know, subscribe, comment, like. That supports me. That lets me know that you're enjoying the videos. If you don't like these type of videos, let me know what type you like. If you want to do a stock breakdown, let me know. Give me the sticker name. If you want to do an ETF versus ETF, if those videos are very entertaining and informational and educational, let me know. I'll do those. I welcome all comments, hate, love, everything. Thanks for watching, guys. Stay tuned. Catch you guys on the next.